the billionaire who predicted the coronavirus crash and made $2.6 billion.
The hotel industry and the restaurant industry will go bankrupt first. Boeing will not survive without a government bailout.
Has all his $10 billion portfolio invested in only 7 stocks. Today we'll see which are his stock picks, why he's not bullish on the stock market in the short term, and when he believes that it's a good time to go all in on buying stocks.
That's kind of a buy signal for markets.
Besides making one of the wildest calls in history during the pandemic bear market, Bill Ackman is also known for his extreme portfolio concentration.
If you want to make high rates of return over a long period of time, it's hard to do that being very diversified.
This approach is also shared by other investors like the GOAT Warren Buffett, who holds 50% of his portfolio in Apple stock.
If you really know businesses, you probably shouldn't own more than 6 of them. If you can identify 6 wonderful businesses, that is all the diversification you need, and you're going to make a lot of money.
But before we see which stocks Bill Ackman bought, let's see his thought process for finding high-quality stocks.
Our principles are basically, we want to invest in simple, predictable, free cash flow generative, dominant companies with large barriers to entry that earn high returns on capital, that have limited exposure to extrinsic risk we can't control, strong balance sheets, don't need access to capital to survive, have excellent management, good governance.
So, at number 7 with 11% weight, we have Canadian Pacific. This is a freight railway company which transports commodities like grain and coal, but also freight like metals, plastic or chemicals. The stock didn't offer great returns this year, but this might be a great pick if you prefer solid value companies. With a phenomenal net profit margin around 40%, this is more of a defensive stock.
And if you think about the railroad business, it's a business where they're not going to build a new one across the street. Absent some fairly dramatic changes in technology, you can be pretty comfortable that goods will be shipped on rail for a very long time to come.
Next, at number 6 with 12% weight is the real estate company Howard Hughes. In spite of the revenue being very volatile, the company maintained really good operating margins during the last couple of years. Ackman has invested in this business for the first time in 2010 and has added heavily during the last couple of years. Actually, he believes in the company so much that he serves as the chairman of the board. However, please note that this is a very risky stock that has underperformed during the last couple of years with a 40% loss in the last 5 years.
No! God, please, no! No!
Now, before we go into Ackman's top 5 holdings, I want you to notice that 4 out of these 5 stocks are consumer discretionary companies. These are all tied up to how much money do consumers spend, which tends to decrease in periods of high interest rates and economic uncertainty.
I was asked by a student, what's the single best business in the world? I said, if you could own a royalty on people spending money, like Visa or MasterCard, it's the greatest business in the world.
And a great example is the fifth position with 12.5% weight, which is Hilton. This huge hotels and resorts company is a blue chip stock that is a volatile business because people tend to travel less during economic downturns. However, unlike the real estate company, the stock rides a beautiful bullish trend line with a return of 18% for 2023. Next, at number 4, with 13% weight, we have Google.
Missing Google can be as important a mistake, or maybe even a bigger mistake, than making a bad investment that doesn't work.
After Google Cloud became profitable in 2023, Ackman sees upside potential as he just opened a position at the beginning of the year. Moreover, Google's advancements in AI will be paramount for future growth as the advertising giant faces intense competition from other large language models like ChatGPT. Ackman increased his Google position 16% in the second quarter, so he benefited from the 45% year-to-date return that Google stock offered. Next up, at number 3, we have Lowe's. This is one of the biggest retailers of home improvements in the United States. The revenue growth tends to be really volatile as the revenue is expected to decrease 9% for 2023. Still, the company generates net profits with an 11% net margin. However, it is a capital-intensive business and has significant amounts of debt, so I believe this is a pretty risky business. Lowe's used to be Ackman's number 1 position in his portfolio, but he decreased his exposure by 25%. At number 2, we have Restaurant Brands with 17% weight. This company owns several fast food brands like Tom Hortons or Burger King. This is yet another slow-growing company with great net margins around 15%. But in 2023, the stock has been underperforming after the stock had a 12% drop. This means that from the end of June, Bill Ackman lost more than $230 million on this stock alone. Finally, at number 1, the biggest position in Ackman's portfolio with almost 19% weight is Chipotle.
I eat on a regular basis at Chipotle. I like the food. I think it's healthy. I think it's good for America. I think they got a sustainable moat around their business.
This is another fast food chain stock which Ackman bought since 2016, and it provided his best return so far. And by now you've probably noticed that his top 2 positions are fast food restaurants. And the reason why Ackman is so focused on fast food chains is because he sees these businesses as recession proof.
In a recessionary environment, historically people don't stop eating out, but they might adjust from the sit-down restaurant to a fast food environment or a place. Fast food, if you will, the quick service restaurants have generally done well in recessionary environments.
Chipotle grows nicely while improving margins, and it's also generating high amounts of free cash flows. As a result, the stock grew around 37% in 2023. However, in spite of owning these high-quality businesses, Bill Ackman is not bullish on the short term. He's actually shorting the stock market after the US credit rating has been downgraded because he sees the yields going much higher, and when yields go higher, long-duration assets are worth less. At the beginning of August, Ackman posted his prediction for the short term. He sees inflation remaining elevated because of things like deglobalization, higher defense costs, the energy transition, and greater bargaining power of workers. As a result, he would be really surprised if inflation somehow drops below 3%. And because of the persistent inflation, he sees interest rates growing even more. That's why he chose to short the 30-year treasury bonds, both to hedge his portfolio, but also because he sees it as a profitable payoff. So far, it seems like Ackman was right, with the 30-year treasury yield growing from 4.17% to 4.3%. This is also the same day when the stock market started this short-term bear trend. Moreover, the Fed's recent actions support Ackman's stance, as Jerome Powell just confirmed that the Fed will keep rates elevated until inflation is brought back to their target.
12-month core inflation is still elevated, and there is substantial further ground to cover to get back to price stability. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective.
However, in spite of the recent short-term risk, Bill Ackman is long-term bullish on the stock market, as he believes that there will come a moment when we could all go in on equities.
I think once people realize the Fed doesn't have to keep increasing rates and will soon be taking rates down, that's kind of a buy signal for markets. But what they're not going to do is take rates to 4% and see a good inflation print and then start taking interest rates down again. They're not going to make that mistake.
To sum up, Bill Ackman owns many solid businesses with stable growth and significant net profits. Still, he believes that inflation will be sticky, interest rates will remain elevated for the foreseeable future, and we should be hedged in the equities market. Even if we're holding solid companies in our portfolio, we should still be patient and not go all in just yet. If you feel like you've learned anything of value, please hit that like button and subscribe. If you want to compare Bill Ackman to another billionaire with a concentrated portfolio, you can watch this following video.